Hi, I'm David Harmon, and this is my partner Keith Cook. We are real estate brokers with RE/MAX in Bellingham, Washington.
On our website, a lot of people were searching real estate terms, so this video specifically, this series will be for real estate glossary or lingo or terms that realtors or brokers are using in real estate. So hopefully you like it. We are brokers. The end result is what we're hoping for, is that people like what we have to say. They want to list their property for sale or help them find a property to buy. So check it out, like, subscribe, and hope you enjoy.
Quiet enjoyment. Use and possession of real property without the interference from the previous owner, the lessor, or anyone else claiming an interest in the property.
Once you sell a property, traditionally the seller has given up possession, and so you would have quiet enjoyment not dealing with that past seller. We just are in the process of selling a property right now where that's going to be kind of limited because it's an acreage piece and the people were camping there, and we might allow the seller to come back and camp every now and then. So that's limited, I guess.
Yeah.
But for the most part, if it's your property, whether you own it or rent it, you should be able to have use of it the way that you would want to use it. Sometimes where I think we infringe on that a little bit is if you're renting a property and then the owner decides to sell it. And I'd see that as an interruption of quiet enjoyment, because now people are coming through and taking a look at it. Usually there's a provision in the lease that's going to state that the seller can either show it to prospective tenants or prospective buyers, and that's already pre-negotiated, but it does kind of dampen the quiet enjoyment of it. The best way, I would say, to secure quiet enjoyment forever would be to own real estate versus leasing it, because if you lease it or rent it, someone can come in and interrupt your enjoyment. If you own it, you're going to limit those opportunities for people to come mess with you, because if you don't have a landlord, you don't have a landlord. Quiet title action. A lawsuit to determine who has the title to a piece of property or remove a cloud from the title. Title can be funny in Washington state, and sometimes the ownership can be a little ambiguous as far as who really has title to the property or not. So basically a quiet title action is just going through the courts and have the court to determine who actually has a piece of property. It might be ownership of the property, it could be an adverse possession type thing, it could be an easement, but it's basically just going through the courts to establish the ownership or right in real estate.
Ready, willing, and able. A buyer is ready, willing, and able if he makes an offer that meets the seller's stated terms and has the contractual capacity and financial resources to complete the transaction.
So if you're ready, willing, and able, give us a call. Those are our favorite peeps to work with, because you're ready to go. And we're ready, willing, and able to help you out. So I just think it means you're ready to go versus not ready to go.
Yeah.
Versus ready, willing, and not able.
Yeah.
Or not ready, but willing and able.
Yeah.
I think you need all three of them, and then you're good to go. Real estate contract. There's three definitions here. One is a purchase and sale agreement. The second is a land contract. And the third is any contract having to do with real property.
Yeah, real estate contracts can be drawn up in multiple ways. So it can be drawn up by a real estate broker, an attorney, an individual at a coffee diner on a napkin. There's multiple ways that actually real estate contracts come into effect.
What I see is with real estate contract, it's interesting because it has three different definitions or terms. And so I think for the most part, we would consider a contract, a purchase and sale agreement, that's a contract. There's also something that doesn't happen that often on a real estate contract. It's like a type of owner financing. It's a real estate contract versus a deed of trust. And on a deed of trust, which 99% are used, your lender is going to have a deed of trust with a promissory note to pay. And that's when you're actually deeded the property. It's your property, but it's subject to a lien. It's your property. On a real estate contract, if you own it free and clear and you sell it to someone, it actually still stays in the parties who sold its name, and then subject to the real estate contract. So title isn't really transferred until it's paid in full. A little interesting that doing that way. And then I guess just the idea of what they're saying is just a contract in general. So if you have an agreement to purchase, then that's a real estate contract.
Real estate firm, a business entity licensed to offer real estate brokerage services under the supervision and control of a designated broker, also known as a brokerage.
And so for the most part, this is where all brokers work. So there's one company, we're at RE/MAX. We have one designated broker. Each office only has one designated broker, and everyone else falls under that main designated broker's license. Whether you're a managing broker or just a real estate broker, everyone works for one real estate designated broker in that firm.
Real Estate Brokerage Relationship Act, a Washington state law that significantly changed traditional agency law in regard to real estate transactions. It governs when and how real estate agency relationships are created and terminated, the duties owed by real estate licensees to the parties to a real estate transaction, and when and how agency disclosures are to be made.
And if you want to check it out, it's online. It's RCW 18.86, and that'll go over the definitions and agency relationship, duties of a broker, violation of licensing law, seller agent's duties, buyer's agent's duties, dual agent's duties, duration of agency relationship, compensation, liability, imputed knowledge and notice, application, and the effective date of this was 1996. So we do, as brokers, have to give buyers an agency pamphlet, so that's provided to every buyer and seller in a transaction. Rules have changed. Washington State used to be everyone represents the seller state, and there were some issues with that, with sellers having people or buyers brokers that they've never met representing them and making representation. So it's changed a lot since I've been in the business. I started off and we both did, just only representing the seller. There weren't buyer agencies. Then that switched. And then, I don't know, a few years ago, it switched from agents to now we're all considered brokers in Washington State. So it's basically the act on how we're supposed to perform our duties. We are licensed. We do have to take tests in order to have a real estate brokerage license, and we have to do continuing education. So for the most part, like I'll tell people, I'm not going to do anything to jeopardize my license. So for the most part, working with a real estate broker, there's certain rules and regulations we have to go through. So if we're doing a bad job, you can turn us in.
Realtor, a real estate agent who is an active member of a state and local real estate board that is affiliated with the National Association of Realtors.
It's Realtor, not Realtor. So good job. I like it. Sometimes it's funny. It's mispronounced quite often. Not that it's a pet peeve, it's just the way it's supposed to be pronounced. It's kind of cool. What I like about being a realtor is there's a code of ethics, and I feel that it's kind of for a higher good for everything. So offices have their choice if you're going to be a realtor office or not. And some of the larger franchises require everyone downline to be in the same group. So RE/MAX is a realtor office, so everyone in RE/MAX is realtor. There's some offices that aren't realtors, and so no one in that office is a realtor. So you can't have like an office of 10 people and 5 are realtors and 5 aren't. Either you're in or you're out. For the most part, we pay dues, and I think there's a lot of property rights that realtors do help people with and actually advocate for people's real estate rights, because there's a lot of rights being taken away, and I think the Realtor organization does a great job of helping protect those. You know, recently we had some of our all kinds of rights. So we'll see our attorneys show up, and we have political action committees, things like water rights or building rights or what you can do with your property. So there's a lot of rules that legislation's tried to put in place about real estate, and I think the Realtor organization is probably in the forefront of helping protect your property rights.
Yeah, right. And so everybody is a real estate agent, but not everybody is a realtor. So that's kind of the difference. Like Keith was saying, the realtors has a little bit higher level of ethics that they have to follow, a little bit more education So it's kind of a give and take. Some people like it. We really enjoy being realtors. Reconveyance, releasing the security property from the lien created by a deed of trust by recording a deed of reconveyance.
So a lot of this has to do with title or public record or knowledge. So if you're to purchase real estate and you have a mortgage on it, that mortgage or promissory note deed of trust is actually, the deed of trust is recorded against the property. And that's on that property until it's removed. And so if you sell the property or you pay it off, you want to make sure that that loan is identified as being paid off. And the procedure for that is a reconveyance. It's actually recorded against the property so everyone knows as public record that that debt has been satisfied.
Yeah, it's a pretty simple process. The mortgage lender will contact either a trustee or an attorney in that situation, title company, escrow in our case usually. And then that will be recorded with the assessor's office, releasing that lien on the property or a cloud on title, thus leaving you the house free and clear in your name.
And it's not uncommon that reconveyances are skipped or missed. So if they're private parties, sometimes they're missed. If they're HELOCs, home equity line of credit, sometimes those seem like they're missed. So usually we'll find out if there is a mortgage, or someone may say, oh, I paid that off 20 years ago. Well, it just didn't get taken care of. So really the only way to truly know would be to look through your title history and see if you had a loan a long time ago, was there a reconveyance deed filed with the county regarding that. We run into those, several times a year we run into this situation. So it's something we can deal with, but it is, it's interesting trying to see how people don't get these recorded against their property. Usually in a real estate transaction, in every transaction we'll get a title report. And occasionally on some of these title reports, we'll see a loan that did not have the reconveyance recorded for a property that was actually paid off. So it's important to make sure that if you have a mortgage and you do pay it off and you still live there and own the property, that a reconveyance is recorded, showing that the lien is satisfied.
Recording, filing a document at the county recorder's office so that it will be placed in the public record.
And this happens every transaction we're involved with, deals with recording. So at the final stages, if a buyer is purchasing the property, the seller will give them a deed to the property. And that deed is essentially recorded, showing that the ownership has transferred from the seller to the buyer. And that gives everyone public notice. So that's kind of the important part, is recording something gives notice to the entire public that this is now your property.
And that's really what you're going for in the whole real estate, from the home plate to the finish line, is you're waiting for that recording date, because that means that you actually own the property. Every step along the way until that point in time is just one of the steps. The recording is the finale,
right,
where you actually own the house, you get the keys, you can move in.
Game, set, match.
Yep. Recording, filing a document at the county recorder's office so that it will be placed in the public record.
And this happens every transaction we're involved with, deals with recording. So at the final stages, if a buyer is purchasing the property, the seller will give them a deed to the property. And that deed is essentially recorded, showing that the ownership has transferred from the seller to the buyer. And that gives everyone public notice. So that's kind of the important part, is recording something gives notice to the entire public that this is now your property.
And that's really what you're going for in the whole real estate, from the home plate to the finish line, is you're waiting for that recording date, because that means that you actually own the property. Every step along the way until that point in time is just one of the steps. The recording is the finale,
right,
where you actually own the house, you get the keys, you can move in.
Game, set, match.
Yep. Redemption, when a defaulting borrower prevents foreclosure by paying the full amount of the debt plus costs. Or number 2, when a mortgager regains the property after foreclosure by paying whatever foreclosure sale purchaser paid for it plus interest and expenses. Sounds a bit confusing, but
It's kind of cool. There's a way still to get back into the property even if you're in default. So you're in default, you missed a few payments, just bring it current and you can, you're in redemption and you've satisfied your outstanding default. So you're back to being in good graces. So you've redeemed the loan. The other one, it's a little bit trickier with some of these sales because there's sheriff sales and some sales dealing with foreclosures, tax foreclosures, where there's a right of redemption. So even if you are foreclosed on, you still have a right to come back later and cure the default. So I haven't really dealt with those that much, but it's kind of the process of redeeming those defaults.
Right. So like we've said in some of our other videos, there's usually a plan B. Like if you get to a point, you're not just done and finished. You can always usually come up with a game plan to get back what you feel is yours and not just walk away. So stay in the game and try to reach out to somebody like Keith and I and see if there's a resolution to your end game.
The lenders don't want to take your property back, so they would much rather work with you, set up a payment schedule or modify your loan so you can get back on track, because they spend a lot of time on default mortgages and that's not their business. They would rather just be lending the money and move on to the next one. So they do not want your property back. They'll take it back if they have to, if they're forced, but that's not their whole goal plan.
Refinancing. When a homeowner takes out a new loan, usually to take advantage of a lower interest rate, and uses those loan proceeds to pay off the existing loan.
I love refinances. Gotta be honest there. So it's so cool with buying a home, and so you buy a home when you're younger, obviously if you're older, when you're gonna refinance it, but you've built up some equity in the home and you wanna tap into it. So it wouldn't necessarily just because rates are lower. It may be that you have some debt that you want to pay off or do a home improvement. So you would use your home as collateral to borrow, say, $100,000 to go do what you want to do with it. So I think it's pretty cool that way. Rates have been historically so low that people have almost been like leapfrogging downwards to try to get lower interest rates. So if you bought a house and say it was at 5% interest, and then a few years later, it's at 3.5% interest, it financially makes sense for you to go through, apply and do everything for the mortgage again to get a lower interest rate, because that will lower your payment and you can pay it off quicker. There's also, I guess, somewhat with refinancing, if you only want to take a partial refinance or a little bit of money and you want it to be reoccurring or have the ability to borrow against it later, you would do what's called a home equity line of credit. And the main difference with this is, say it's a $100,000 home equity line of credit. It's just sitting there stagnant, not drawing any interest whatsoever until you decide to use it. So if you take $50,000 out, you're only paying on that $50,000. It's a little higher interest rate than if you were a fixed second. A fixed second, say you borrow that same $100,000, that money goes into your account. So they're giving you the $100,000 and you're paying on that each and every month, whether you're using it or not. So kind of a benefit of the HELOC is that it can go up and down. You could pay the $50,000 off if that was your balance and you're back to zero. A couple years later, you wanted to borrow $70,000. You just go right there. There's no more paperwork to do. You just call your bank and have them transfer $70,000 from your HELOC to your checking account and you're good to go. So it's a great tool. I think it's great for emergencies. So if people have this ability, if somewhere down the road you need an emergency $70,000 for whatever reason, instead of going through a couple month process of doing a home equity line of credit, you've already got it established and you're set up ahead of time. Real Estate Investment Trust, also known as a REIT, is a real estate investment business with at least 100 investors that qualifies for tax benefits if organized and managed in compliance with the IRS rules. And we're kind of seeing some of these pop up. They've been around for a long time. It's just a way, almost like a stock thing. You can buy, instead of Apple or Ford, you can buy in a REIT, which is basically they own real estate. And I'm seeing some of these come up. I just saw it the other day where they're even doing these like fractionally, where you can go and buy, like $100 worth of a house with the idea that they're going to hold it for a few years and then sell it in 7 years, and you can collect some rent on it. So it's kind of cool that there's now, I guess, incremental ways to get into real estate. It's almost like you don't have to buy a whole Bitcoin. You can buy a little piece of it.
Yeah, it's kind of a good way to get involved in real estate. Now, if you don't want to have to deal with tenants and plunge toilets or whatever, you can still be in the real estate market and be an investor without the day-to-day hassles of being the actual owner. Release clause, a clause in a blanket mortgage or a deed of trust which allows the borrower to get part of the security property released from the lien when a certain portion of the debt has been paid or other conditions have been fulfilled, often called a partial release clause. Second definition is a clause in a land contract providing for a deed to a portion of the land to be delivered when certain portion of the contract price has been paid, also known as a deed release provision.
And these are, I would say, instrumental on the first definition, dealing with subdivisions or construction. So it's mostly, say you're building 100 lots or 100 homes, you borrowed money to service and put the roads in for the 100 homes. It's a big mortgage. Now you're going to sell one of these houses. Well, the mortgage is on all 100 lots. How do you release the mortgage that covers all of them for selling one house? So usually that big master loan you're going to get will have a deed release provision saying, if you sell this one house, now from that one house, we may get a percentage or what we determine the lot value it is. So it might be you sell the house, 200,000 of that has to go towards the loan, and then we'll lower the loan by 200,000 and we'll release that lot so you can sell it. So it happens all the time in development, and that's how builders are in a position, or developers are in a position to satisfy those lenders.
Remainder, a future interest that becomes possessory when a life estate terminates and that is held by someone other than the grantor of the life estate, as opposed to a reversion, which is a future interest held by the grantor or the grantor's heirs.
I guess in theory or practically how this would happen, you're gonna have someone who owns a piece of property, and they're either gonna work with a family member or a different third party, but essentially they're gonna sell the property or give the property to someone else. As part of the consideration of that person gets to remain in that property for the rest of their life. And the title's been transferred. You transfer the title right now. It's almost like a rental agreement. I don't have to pay rent. I get to stay here till I pass away. Once I pass away, then it's determined right now who that's going to go to, and that would be the remainder. So once you have passed away, the other person's going to get the remainder for the rest of eternity for that piece of property. So it's an interesting way to do a transfer. A little different than we'll do like possession, rent and back a few weeks. So this gives you possession of the property the rest of your life. I see it happening mostly, I would say, with development property or some type of family situation where it might come in to where people want to work with their kids, but they have an accessory dwelling unit on the property, but they want to stay there forever, but give the kids the title to the property and use of the money. So it can be a win-win situation if used properly.
Rent roll, a report of rent collections, a list of the total amount of rent earned, both collected and uncollected.
And this term's used in some type of investment property, whether it's an investment single family house or a 10-unit apartment or a commercial building. It's a report showing what all the rents that it's supposed to be and what have you received. And so it's important. Most buyers are going to want to see that, what the actual rents are, versus like a pro forma, which is going to say what the rents could be. So this is actual rents and where the standings are with each tenant.
Rescission, when a contract is terminated and each party gives anything acquired under the contract back to the other party.
I don't like this term. It's probably one of my least favorite terms so far on this series. Usually it's going to happen when a buyer changes their mind, and that can happen for a variety of reasons. Traditionally, what we're going to see is we have mutual acceptance, buyer and seller enter an agreement say it's a house and the buyer wants to have an inspection on the house, and the inspection identifies problems that the buyer wasn't aware of or doesn't like, and for somehow the buyer and the seller can't get over whatever this obstacle is. So let's just say it needed a new roof and the seller's not going to put a new roof on, and the buyer needs the new roof or doesn't want to buy it. So if they don't have a meeting of the minds anymore and they're not moving in the same direction what they would want to do, that agreement needs to be canceled, because we had an official binding contract, and to unbind that contract, all parties agree to sign a document stating the agreement is over and release each other from liability from that sale.
Yeah, one step, usually in that situation too, there's earnest money involved, and in order for the buyer that put up the earnest money to receive his earnest money back, they do need a rescission signed by both parties in order to release that money back to the buyer.
And that's assuming the buyer gets it back. So the example I used, the buyer had a right to rescind, and that was based on the home inspection. But if you make it past the inspection or appraisal and you just change your mind as a buyer, if you just flat out change your mind before closing, you still have to formally deal with the transaction. And there's terms in the agreement that are going to state as far as specific performance or how people will deal with each other. But at the end of it, the rescission is an agreement between the buyer and the seller that the agreement is over, and the rescission documents will usually identify if there is an earnest money, how is it distributed? Because it can either go to the buyer, the seller, the brokers have a chance at this, and so we don't really know where it goes all the way, and they're our least favorite form, because usually everyone was working so hard to try to put a sale together, and for some reason it just didn't work out. So they are out there. Not every deal comes together, and the way you formally withdraw an offer is with a rescission.
Reservation, a right retained by the grantor when conveying property. For example, mineral rights, an easement, or a life estate can be reserved in the deed.
Yeah, it's just an understanding that you might buy a whole piece of property and then you want to have some entitlement in it or sell all of it, but maybe keep part of it. So it might be something like you have two pieces of property and there's waterfront, and you're selling the actual waterfront and you've got the lot behind it. You want to have access to go to the lake, so you have an easement or a reservation for that you're going to grant yourself a right to use that later.
Yeah, and you'll also see it in mineral rights or oil rights or whatever that people keep back on the property. So you're going to own the house and everything else, but anything below the ground, the mineral rights will be reserved in the deed for the party involved.
An easy way to look at it, a reservation, is you're not 100% getting deeded fee simple. There's going to be some type of little, I guess, catch to it somehow, whether you don't have your mineral rights, which really isn't a big deal, at least here in Washington. There's some areas where we have mineral rights used a little bit more. There used to be like coal areas in some of the locations in Bellingham. So someone had, say, 1,000 acres and then they sold a bunch of it, but they were saying, we'll sell the property, but we want the right to get the coal. And so that'll show up on your title report. You'll say, all right, you get the property, but you don't get the coal rights. And that's something important with the title policy. It'll actually show if there are any reservations against a property. You'll be identified and you'll be able to understand what those are up front.
Reserve account, a bank account maintained by a lender for payment of property taxes, insurance premiums, and other recurring expenses connected with a security property. The lender requires the borrower to make regular deposits and then pays the expenses out of that account. It also could be considered an impound account or an escrow account.
And it's actually the easiest way for a residential homeowner to deal with their mortgage. So you're going to have basically 3 payments that they're all putting as one. So you're going to have your principal and interest payment to your lender, and that's going to be easily calculated. That number really on a fixed rate mortgage isn't going to change for 30 years because we've calculated that up front. What can change is your insurance premium or your property taxes. And so those can go up and down, and so you don't know what's making all these payments. And the lender is going to want to make sure that you have the property insured and that you're paying the taxes. So usually what they'll do is they'll take like a 6-month reserve of each of those amount, and keep that in a separate account. And they will try to calculate what they think your principal, interest, taxes, and insurance payment is, and then that is your monthly payment to them. Then when the taxes come due, the mortgage company pays the taxes. When the insurance comes due, the mortgage company pays the insurance. So it's an easy way to make sure all the bills are covered. If you do sell the property, you kind of have a little nest egg there. So it's not uncommon you sell a property that you're going to get your reserve count back for your taxes and insurance. So you will get a little bump after you sell the property.
Reserves for replacement. Regular allowances set aside by an investment property owner, a business, or a homeowners association to pay for replacement of structures, equipment that are expected to wear out.
In Whatcom County, where I think we see this happen most often is in condominiums. And it makes sense that people in a condominium know what's coming down the pike for future repairs. So if you're looking to paint all the units in a couple of years and it's going to cost a bunch of money, greater than your regular homeowner association amount each month, what they'll do is they'll ask each person who owns a condominium to chip in an extra, say, $100 a month, and then once they collected enough money, then they will go ahead and pay for that repair or paint job. So it makes sense to keep track of the money and make sure everyone's chipping in their fair share and not end up in a situation where you have it's an emergency where we have a special assessment to where all of a sudden we need to have everyone chip up $25,000 next week. So it's kind of forecasting and trying to come up with an idea how to protect your investment and understand that everyone has different payment schedules and think ahead.
Right. And I'd say, and probably another area that you will see the reserve is for a new homeowner and stuff that's used to renting or whatever. It's a really good idea to have that reserve account because maybe you're not used to having to pay for a broken refrigerator or a furnace or whatever. So if you don't have some type of a reserve account and your furnace goes out in the middle of the winter, it could get cold.
So I like the way you say that because that's really considering it more of an individual versus a group. So I guess we all internally have our own reserve replacement, so we know, if the fridge or furnace goes out, that we're going to budget for it. But sometimes if you're part of a bigger group, so like a condominium, for the most part, you individually take care of your inside, but as a group, you take care of the outside. So it's mostly, I guess, dealing with outside situations that would come up with a condominium. So if it was to be painted and you needed to allocate some money for down the road, then you would do that as a group and understand as a group what's going to happen versus an individual.
Residential Landlord Tenant Act, a Washington state law that regulates landlords and tenants in most residential lease transactions.
And I think this is pretty important to have. So it's basically just a set of rules on what is it like to be a tenant and what is it like to be a landlord. So if you're a tenant, the landlord just can't come in anytime they want. You have the right to, enjoyment of the property. If you're a landlord and someone's not paying, then there's the rights on how to deal with them to either get them to pay or get them the heck out of there. So it really benefits all parties involved with rental real estate.
Yeah, this is definitely an ever-changing act that you'll see, and it updates pretty regularly because it changes, and people and tenants' rights have changed, and landlord rights have changed. So it's something to definitely have some legal advice on because it's definitely a moving target right now.
It's been interesting. I think if people were paying attention to COVID and moratoriums, there was a foreclosure moratorium, there was an eviction moratorium. And so there's the act, and then you can put a moratorium on it to deal with things. And then moratoriums have gone by the wayside now. But it's I think it's important legislator that comes up with the group or the set of rules on how it is to basically either be a property owner or a property tenant, and it's the most fair way, I think, for all parties.
RESPA, or the Real Estate Settlement Procedures Act, a federal law that requires disclosure of closing costs to residential mortgage loan applicants and prohibits kickbacks or referral fees between settlement service providers.
And I think this is a great benefit for buyers or people who are borrowing money. It basically just spells everything out. I recall back in the day, you'd show up at the closing table and all of a sudden there were all these extra fees that people didn't know. They thought they were getting an interest rate, or the interest rate's either higher or they're going to have additional fees that the lender put on, and they just weren't aware of them. So now they're doing it to where if you're going to get a loan, they actually have to send you some paperwork 3 days before actual signing, so you can actually review everything. That's the closing disclosure, but it's pretty cool. I think buyers are more informed and it gives them more information. So kudos for this.
Rezone, an amendment to a zoning ordinance, usually changing the use allowed in a particular zone, also called zoning amendment.
And this will happen on, city and county, it's almost even state level. So in Washington, they have the Growth Management Act, which will kind of require for people to forecast what our population is going to be in the future. Then they have to figure out, each county has to say we're going to have so many people, and then they have to make sure that we have the zoning in place so in the future we're going to be able to accommodate everybody. And so zoning can be upzoned or downzoned. So upzoning might be that you have 1 acre that was for one house, and now you're going to be able to put 20 houses there, or 20 units. A down zone would be you currently have a 1 acre that's zoned for 20 houses or 20 units, and now the new zoning is going to make it so it's only 1. So it's kind of tough. What I like it, you have to have zoning. It's also going to make sure that they don't put a 7-Eleven in every subdivision or houses are out next to Cherry Point or in industrial areas. So it makes sense, and as we're evolving, so zoning is evolving too. So zoning isn't forever. There are amendments you can do. Even the city is putting like bonuses to try to get developer infill. They have an infill toolkit that allows you higher densities if you're developing in town. There's certain sections you get tax advantages. So there's a lot with zoning and what you can and can't do with the property. We've had some property, it looks like you could put a residence there, but it's not. It's like light industrial. So it seems like it might work. So I think all in all, it's for our future to make sure for the people coming up that we're going to identify what type of activities can go on in certain types of properties. Right of first refusal. A right that gives the holder of the first opportunity to purchase or lease a particular parcel of real property should the owner decide to sell or lease it.
Yeah, you'll see this in multiple situations. You might see it with a business owner that's leasing a business from somebody that in their contract they sign the right of first refusal so that the owner of the property couldn't just sell it to somebody else. They'd have to offer it to them first. You may see this in a home purchase. Maybe you're renting or leasing the property from a homeowner, and in your lease contract you signed, it stated that you had the option, the right to buy it before they sold it to somebody else.
It's not standardized, and each opportunity can be a little bit different. Some may give you a week, some may give you a month. It's not an option to purchase, it's a first right. So an option would say you have the right to purchase it at a determined price right now. So you can buy it, say, for $100,000. First right of refusal would mean on a purchase that if you were to sell it, and say you're on the market and you sell it to someone for $100,000, I can say, nope, I got first right, I'm gonna buy it for 100. Maybe you got 90, maybe you got 120, but we don't know that price until it's actually clarified by what the other competing offer is on a sale. We do run into that, and I think it's mostly in commercial where people would want the right as a commercial business to potentially buy the location they're at because they're more vested in that location versus a residential house. So it's a lot easier to move residents than it is a business. So I think it comes in handy. We do see that a lot in commercial leases. So it's out there, and it's a good way to protect yourself as a tenant for a future investment in the property, and if you decide that you want to buy it.
Right of survivorship, a characteristic of a joint tenancy. Surviving joint tenants automatically acquire a deceased joint tenant's interest in the property?
There's a lot of different ways that people are going to own real estate. And at the end of it, it's really like what happens when you pass away owning real estate. So if you're married, it's going to most likely go to your spouse, unless you have a will or something that's going to dictate it otherwise, if it was your second spouse or second marriage or what's going to happen. But for the most part, you're trying to figure out what happens with the property when you pass away. When you would take two unrelated business partners purchasing a property, then that kind of throws a wrench in it as well. Because if you and I own an investment property and one of us was to pass away, well, does it just go straight to the other guy, or would that go to the other person's estate? So it's a complicated situation. We have another full video on how to take title and ownership and deals with these and LLCs and liability. So look for that one on our channel, and we'll get in more detail on that. Just look for that video.
Right-of-way, an easement that gives the holder the right to cross another person's land.
So the right-of-way easement is, say that Dave has a piece of property and his is in front of my piece and I have to cross his property to get to mine. I'm just driving over Dave's parcel to mine on a right-of-way. So it's an easement to get across Dave's property to my property.
Running with the land, binding or benefiting the successive owners of a piece of property, rather than terminating when the particular owner transfers his or her interest, usually said in a reference to an easement or a restricted covenant.
And for the most part, easements do run with the land. So if you have the property where you're going over someone else's property to get to yours, that will be there forever. So when you sell your property, the next person gets to go over the same road. And when they sell it, the same thing, and so on and so on. So it's not like you can just terminate it, or if someone's driving over your property, say, I don't like you anymore, you can't drive on my property. It's actually a legal recorded right to go on that piece of property. It'll run with the land.
Sale-Leaseback, a form of real estate financing in which the owner of an industrial or commercial property sells the property and leases it back from the buyer. In addition to certain tax advantages, the seller, the leasee, obtains more cash through the sale than would normally be possible by borrowing and mortgaging the property, since a lender will not often lend 100% of the value.
And it works great for, I would say, the buyer and the seller in some of these situations. So you can have someone that has a commercial property and ultimately they may want to retire or kind of, be done with it down the road. They could sell the property right now, get 100% of the value, and then make sure, say they sign a 5-year lease. So they know they've got use of the capital right now, and they get to stay there for 5 more years. So that benefits the person selling. The person buying, where that benefits them is, if they're buying as an investment, they're going to lease it out to someone anyways. Why not lease it to the existing owner and have a 5-year lease? And you're going to know ahead of time, based on what your price is and your down payment, what your mortgage is going to be. And then so you'll know right up front, how secure your investment is or what your rate of return would be with that tenant or purchase. So it really benefits all parties if it's a win-win deal. So hopefully we like to work with win-win deals. So situations with sale-leasebacks are usually good deals. Sales comparison approach. One of the 3 main methods of an appraisal, in which the sales price of comparable properties are used to estimate the value of the subject property, also called the market data approach. So where appraisals kick into real estate is if you're going to buy a property and you don't have cash, then you're going to get a loan, and the lender is going to require that an appraiser come out to establish and make sure that the value is okay. So they wouldn't want to lend $1 million on a property that's worth like 100,000 or something. So they'll send the appraiser out, not to be confused with the home inspector who looks at the condition. The appraiser is mostly just looking at the value. And when they look at the value of the property, they'll look at the condition a little bit to make sure it's not falling down, and they'll lend a loan on it that way. It's not a detailed inspection, but it is a detailed analysis of the value of it. They will look at sales comparison, income, cost. There's a few different ways to look at it, but with the sales comparison, for the most part, they'll take similar type homes in similar locations and try to see if they match up. So if you're in a neighborhood and say, I like to say you had the Franklin model of a house in a housing development and 3 other Franklin models just sold in the last 60 days, those are great comparisons. That'll give a good indication as far as what the home the appraiser is evaluating. So comes in handy. They're pretty expensive to get appraisals right now, but it's about impossible to get a loan without an appraisal.
Secondary financing, money borrowed to pay part of the required down payment or closing costs for a first loan, when the second loan is secured by the same property that secures the first loan.
Right now, we don't run into this a ton. I think we'll see it more like commercially if you're going to do an SBA or a small business administrative loan where they will help you with the down payment and get some loans that way. I think there's some with like the state bond program and where you're going to basically work with some other government entities to help with your down payment. It used to be prominent, 20 years ago with seconds. You do like an 80-10-10 where you would do 80% first, 10% down payment, and a 10% second. There used to also be some like seller carryback. So if you do almost like no money down, you'd put no money down and then the seller would carry back 20%. And that was a second. Also look at like disappearing seconds because there's some, I guess, possible corruption with some of those. So people would inflate the price, have the seller carry back 20%, and then forget that 20% was owed. So they would come in with no money down. So it's not as secure as a first mortgage. A first mortgage is in first position. So if anything goes wrong with that property, any default, that first will get paid first. The second mortgage would be in second position. So if there was a default, they could potentially lose that whole value of that second. So a little risky, but it's with financing. There's a lot of ways that people like to lend and make money on financing. So it is an option.
Secondary mortgage market. The market in which investors, including Fannie Mae and Freddie Mac, purchase real estate loans from lenders.
And this is a really huge benefit for residential investors because it pools the funds and gives local banks a chance to have a national place to sell these loans. So you may go talk to your local bank and they may generate a loan and you start making the payments to your local bank, and then you'll find out it was purchased by someone else or it kind of gets moved around. And they are tangible notes. So if you have a mortgage, someone sees the value in that and they will pay for that. So they can be sold privately as well. So if you have a private note and deed of trust where you're selling, you'll get a lot of interest in actually people buying that. But what that does is it keeps the interest rates lower. The banks, local banks, are going to run out of money to finance all of these local purchases. So most of them are sold out on the secondary market. Unless if they're going to do a portfolio loan, that's when your local lender is actually going to their vault, handing you their money from their pooled account that they have from their customers. So financing is a huge part of real estate, and the ability to sell these on the secondary market is pretty big.
Security deposit. Money a tenant gives a landlord at the beginning of the tenancy to protect the landlord in case the tenant defaults. The landlord may retain all or part of the deposit to cover unpaid rent or repair costs at the end of the tenancy.
I think that one's fairly self-explanatory. Sometimes you may have pet deposits or different deposits depending on what you're planning on using the property for. But for the most part, it's make sure to return the property in the same condition as you rented it at, and you should get a return of your deposit.
Right. A lot of times you'll see when you're renting a place, they'll have like a punch list, which is important to have when you move into a place. That just tells everything that was possibly wrong or needing repair when you moved in, so that when you move out, you're not charged for something that the landlord didn't note during the first time. So it's important for you to be involved in that if there is that process of move in, move out, because it can affect your deposit.
It's probably one of the bigger rubs I think that tenants have as far as getting their deposit back, and it's kind of arbitrary to see if you have a, say, $1,000 deposit and the landlord keeps $500, and you're like, well, I did everything right. So it's definitely a rub, depends on which company you're working with. If you're not satisfied with that, you basically need to go to court to try to prove that different. It is important that the landlord actually have that condition report Dave's talking about, because without that, without proof of the actual condition when you moved in, then that's like the benchmark. So if, let's just say, without having that document and the carpets were damaged, you could say it was that way before we moved in. It's not documented, the condition before you moved in. If I was to be a renter, I'd probably go ahead and take pictures or a video of the entire unit before I moved in. So I would have photo proof of the condition when I moved in, especially anything that may have been a damage, if there's a nick in a door or something like that. And when I moved out, I would have the same photo documentation, just with the idea you're not going to know until usually after you vacate how they're going to treat you with that, returning that security deposit. So it's a little arbitrary, but I get the gist of it from a landlord standpoint, that you don't want someone to come in and do a bunch of damage.
Seller disclosure statement, a form that state law requires real property sellers to give to their buyers, disclosing any problems with the property. And I kind of look at it as kind of somewhat of a mini home inspection, because it will give you a little bit of a background of what's going on with the property. The seller has to state whether they're hooked up to like a well, septic, a lot of details like that. Has the roof ever leaked? It'll give you kind of a general overview of what's going on with the property. If there was perhaps a home inspection, they have to note when that was done, and if it was in the recent past. So there's just a lot of information that can be a great advantage for a buyer, and especially an experienced real estate agent, to kind of skim through and note things that may be something that needs to be looked at further when you go actually look at the house, or when you're making a decision to put in an offer.
It's a pretty detailed accounting of what the owner's belief is of the property, but that's not to replace your own due diligence. So if you're going to buy a property, it's nice to have the seller disclosure, but you need to rely on your own investigation as well.
SEPA, the State Environmental Policy Act, a Washington state law that requires an environmental impact statement before the property is developed or altered in a way that would have a significant effect on the environment.
The SEPA forms, we don't run into that often, but when we do, I'm always intrigued by them, because it's pretty cool if you like checking out what's going on with the environment for a piece of property. So they will look at, what kind of birds are in the area, animals, vegetation, wet areas. It's a pretty cool report, and it's pretty detailed. So if you get a chance to look at one, I think it's a good read, and we'll put one down below or somewhere in the link here if you want to see one on some Whatcom County properties. But I think it's good information. They're basically required to make sure that if you're going to develop, that say there was a whole bunch of a certain type of species of animals in an area, that you might not be able to develop there. So protected animals, like if we have in Washington eagles, so if you have a property that has an eagle nest, there's going to be setbacks from that eagle nest on where you can build, so you won't be able to build too close to that. So it'll get into that type of stuff. It'll say if there's porcupines. I mean, it'll go into all of the cool little critters that are in the area.
Separate property. Property owned by a married person that is not community property includes property acquired before marriage or gift or inheritance after marriage.
When you're going to buy something, you have to put how you're going to take title. So if you're a single person, you'll take title as a single person. If you're married and you're taking title together, it'll be as a married couple. If you're going to buy something and you're married, but you're like, I take care of my finances, my partner takes care of their finances, this purchase is mine separately, then that would be your separate property. And usually going along with this, you're going to have some other documentation to support it on why that is separate property. So I think the term they'll use is commingle. So you may have separate property, but if it's not treated right, so it could become your spouse's property as well if you commingle, which is basically, say you had a rental house and you're taking the money out of your joint account to fix it or take care of it versus your separate bank account. So if you're treating this as a separate property, you need to completely treat it separately with all aspects to financing on that. It's kind of tricky because some people, even by living with someone, may have a claim on your property. So if someone just lives with you for 10 years, if it's your significant other, even if you're not married, there's some common law type situations that can occur as far as them having the right to some of your real estate. So it's something worth looking into. We're not attorneys, but we deal with it on every transaction. How is someone going to take title? So it's important to know, and I guess know your rights too. So if you're in one of those situations, you might want to research that a little further. Servient tenant. The owner of a servient tenant, that is someone whose property is burdened by an easement. So in real estate, we're going to run into situations where someone has the right to use someone's property, but they don't actually own it. So if we have two adjacent properties and I have a property, say 5 acres, that touches the road, and Dave has the 5 acres behind that doesn't touch the road. So he can either have his own little access all the way through there that he owns, or he can have the right to use part of my property, which would be an easement. And then there's just terms as far as how you refer to which party is involved with the easement. So in this case, the servient tenant, I'm the front parcel, and so Dave is driving over my property and I serve his piece of property. His tenancy would be a dominant tenancy because he actually has the right to drive over my piece. So it's a term used in real estate for how to describe who's used in an easement. Setback requirements. Provisions in a zoning ordinance that do not allow structures to be built within a certain distance of the property line.
Yeah, setback requirements are definitely a big issue, especially in Whatcom County. I think probably anywhere as regulations change and laws change. But especially if you're buying a piece of land and you think you can build a house in one spot, you may need a little bit of help to know exactly where the house can go.
So we'll have setbacks from a few different areas. So I think traditionally you'll have from your property lines. So there may be something like 5 feet, say this is residentially, 5 feet on your sides, say 20 feet, 25 feet from your front yard, and then you'll have a rear yard setback. Where that can change a little bit is if you're dealing with a body of water. So if you're at a lake, there may be a farther setback. If you're dealing with ocean or river, there may be a farther setback. If you have a critical area like a steep slope, there'll be a different setback. If you're dealing with wetlands, there'll be a setback. Septics have a setback. Wells have a setback. Sometimes there might even be limitations on the plat as far as where the home can't be, because if there's a view corridor or something. So with raw land, it's interesting to make sure where the setbacks are. For the most part, you'd have to assume that if the house is there existing for a while, it's already met those setback requirements. Now, commercial is different because commercial you can go, they're gonna have setbacks too, but sometimes you can go all the way to the property line and the setbacks are just adjusted for the type of property it is. But it basically makes sense that there's gonna be rules on building, construction, residentially or commercially, that you're gonna all kind of fall into the same guidelines. So you just can't go build, in a residential neighborhood, go 0 lot line and then build up 80 feet. That's not going to fit in with a residential neighborhood. Settlement statement. A final, detailed accounting for a real estate transaction listing each party's debits and credits and the amount each will receive or be required to pay at closing. The closing disclosure includes the settlement statement, also called a closing statement. The settlement statement is pretty important at the end of a transaction because someone's going to close, say, on a specific day, and there's going to be some expenses the buyer's going to have and some expenses the seller's going to have. And escrow will deal with each of them. So some absolutely the buyer, all costs associated with the loan, buyer's court, right? Most parts with the seller paying their costs off their loan, their fees, their brokerage taxes, There's one fee that's split, which would be actually the person who prepares the settlement statement, or the escrow fee. That's someone who is a neutral party who doesn't represent the buyer or the seller. Their basic job is to figure these numbers out and simultaneously transfer the buyer's funds for receiving the deed. There's some things that will be prorated, like property tax. So if there's 365 days in the year and you close on, day 27, how do you figure the property taxes out? Because they're really not due for 2 more months. And so they will actually have the seller chip in $27 of taxes at closing, and that'll show as a credit to the buyer. They're important to have. You want to save them for your taxes, because if you buy or sell, there's some of those fees that will be associated with your when you file your taxes the following year. So make sure to save that. We actually send every customer we work with that settlement statement again January 1st, just so they're prepared to do their taxes the following year.